Welcome back. Today we are breaking down exactly how to start investing in stocks for beginners. By the end of this video, you will understand why investing is the ultimate 2026 side hustle. Forget driving for ride shares or taking endless online surveys. Your money should be working for you. We're going to cover everything from opening your first brokerage account to picking index funds. In 2026, inflation is still a factor, making investing your cash absolutely critical for survival. Leaving your savings in a traditional bank account means you are actually losing purchasing power daily. So what exactly is a stock? It is simply a tiny piece of ownership in a company. When you buy a share of a massive company, you officially become a part owner today. If that business grows and becomes more profitable, the overall value of your ownership piece increases. You absolutely do not need to be a wealthy millionaire to get started in the market. Thanks to modern fractional shares, you can literally start investing today with as little as $5. That means you can own a piece of $1,000 stock without needing $1,000. This low barrier to entry is exactly why investing is the most scalable side hustle available. It does not require your constant physical labor, and it works quietly in the background every day. Before you buy anything, you need to understand the difference between individual stocks and index funds. Picking individual stocks can be exciting, but it also carries a significantly higher level of financial risk. If that single company has a terrible earnings report, your entire investment could drop very quickly. That is why most successful beginners start by investing their money into broad market index funds. An index fund groups together hundreds of top companies into one single, easily manageable investment package. The most famous example is the S&P 500, which tracks the 500 largest American companies. When you buy an S&P 500 fund, you are essentially betting on the entire American economy. Historically, the S&P 500 returns around 10% annually over a long period of time. That 10% historical average is how ordinary people build extraordinary wealth over several long decades. It's called compound interest, and it is the secret engine behind every successful retirement portfolio. Compound interest simply means that your earned interest starts earning its own interest as time passes. Let's look at a quick example to show you exactly how powerful this math becomes. If you invest $200 every month for 30 years, you contribute $72,000 total. But thanks to compound interest, that account could grow to over $400,000 eventually. You did not work any extra hours for that massive profit. Your capital did the heavy lifting. Now that you see the potential, let's talk about exactly how to set up your account. First, you need a reliable brokerage platform. Think of this as the bank for your stock investments. There are dozens of great zero-fee brokerage apps available on your phone right now in 2026. Look for platforms that offer zero commission fees, fractional shares, and an easy user interface design. Opening an account takes less than 10 minutes. You just need your basic personal identification details. Once your account is officially open, the very next step is linking your primary bank account. You'll transfer your starting capital from your checking account directly into your new brokerage account. But remember, simply moving the money over does not mean you are actually invested in the market. Your money will just sit there in cash until you manually select and purchase an actual asset. This is a very common beginner mistake. Make sure you actually execute the final buy order. So what should you buy first? Let us discuss the concept of exchange-traded funds, or ETFs. ETFs trade exactly like individual stocks, but they contain a highly diversified basket of many companies. They are the perfect safety net for new investors who want broad exposure without deep research. A great starting point is a total stock market ETF or a dedicated S&P 500 ETF. These funds instantly diversify your hard-earned money across hundreds of the most successful businesses on Earth. This strategy dramatically lowers your overall risk because you are not relying on just one company. If one company in the fund goes bankrupt, the other 499 can balance it out. As you build your portfolio, you must decide on a consistent and realistic investing schedule today. The absolute best strategy for beginners is a concept called dollar cost averaging, which reduces emotional panic. Dollar cost averaging means you invest a fixed amount of money at regular, scheduled intervals without fail. For example, you might decide to invest exactly $50 every single Friday, regardless of headlines. If the market goes up, your $50 buys slightly fewer shares of that specific fund. If the market drops, your $50 automatically buys more shares at a heavily discounted price. Over time, this smooths out the volatile bumps and completely removes the stress of timing the market. Attempting to perfectly time the stock market is a guaranteed way to lose your hard-earned cash. Even highly paid Wall Street professionals fail consistently when they try to predict short-term market movements. Your ultimate advantage as a beginner is having a long-term time horizon to let investments grow. Before you invest a single dollar, you absolutely must have a solid emergency fund in place. The stock market will experience sudden drops, and you never want to be forced to sell early. Keep 3 to 6 months of basic living expenses safely tucked away in a high-yield savings account. This protective cash buffer ensures you can leave your stock investments completely alone during a sudden panic. Let us shift focus to what makes the 2026 market landscape unique for new retail investors. Artificial intelligence infrastructure is completely reshaping how major technology companies spend their massive capital expenditure budgets. Companies supplying data center hardware and advanced semiconductors remain a massive focal point for aggressive growth. However, chasing wildly hyped tech stocks at peak valuations can be very dangerous for absolute beginners. That is why experts highly recommend balancing aggressive tech growth with durable cash flow generating dividend companies. A dividend is literal passive income. You can choose to cash it out or reinvest it automatically. Reinvesting those dividends buys you more shares, which then generate even more dividends the next quarter. This creates a powerful snowball effect that rapidly accelerates your wealth-building journey over several long years. We also have to acknowledge that 2026 brings midterm election volatility, which often shakes the markets. Historically, markets can trade sideways or experience noticeable corrections during the months leading up to November. Do not let this normal political volatility scare you out of starting your wealth-building journey today. In fact, temporary market corrections are actually fantastic buying opportunities for long-term investors adding to portfolios. A 20% market drop simply means the best companies in the world are on sale. The worst thing you can do during a market downturn is panic and sell all your assets. When you sell during a crash, you permanently lock in your losses and destroy future growth. The most successful investors in history simply stay the course and continue buying through the fear. Let us break down a simple 3-fund portfolio strategy that takes 5 minutes to manage yearly. This lazy portfolio provides complete global diversification without requiring you to constantly read boring financial reports. First, allocate the largest portion of your portfolio to a broad United States total market fund. This captures the growth of domestic giants like Apple, Microsoft, Amazon, and hundreds of smaller businesses. Second, add an international stock fund to capture the massive economic growth happening outside the states. This protects you if the domestic economy slows down while emerging global markets continue to rapidly expand. Third, depending on your age and risk tolerance, add a small percentage of stable bond funds. Bonds act as a shock absorber for your portfolio, providing steady income when stocks become volatile. If you're in your 20s, you might skip bonds entirely to maximize your aggressive growth. If you're closer to retirement age, bonds become crucial for preserving the wealth you built. The beauty of this simple three-fund structure is that it requires almost zero daily active management. You just set up your automated weekly deposits and let the global economy do the work. Let us talk about taxes, because ignoring them can severely damage your long-term investment return rates. If you buy a stock and sell it for a profit within a year, you pay more. This is called a short-term capital gains tax, and it eats heavily into your hard-earned profits. However, if you hold that exact same stock for over a year, your tax rate drops. Long-term capital gains taxes are significantly lower, which heavily rewards patience and long-term holding strategies. Better yet, consider utilizing a tax-advantaged retirement account, like a Roth IRA, for your first investments. With a Roth IRA, you invest money that has already been taxed from your regular paycheck. The massive benefit is that all your future growth and withdrawals in retirement are completely tax-free. Imagine growing your account to $1 million and owing the government absolutely nothing upon withdrawal. It is widely considered the single best wealth-building tool available to the average retail investor today. You can still invest in those exact same index funds and ETFs inside your Roth IRA. Let us address the most common excuse people use: "I don't have enough money yet." Waiting until you have a massive lump sum of cash is a mathematically proven losing strategy. Time in the market is vastly more important than trying to perfectly time the stock market. Every single day you delay investing, you are losing the mathematical magic of daily compound interest. Start with whatever you can genuinely afford right now, even if it's just $10. Building the absolute habit of investing consistently is much more important than the initial dollar amount. Treat your investment contribution like a mandatory monthly bill that must be paid before buying luxuries. Pay yourself first. Automate your transfers so the money moves before you can even spend it. You will be absolutely shocked at how quickly those tiny weekly contributions grow over a year. Another massive trap for beginners is taking investment advice from random influencers pushing sketchy penny stocks. If someone guarantees you a massive, risk-free return overnight, they are almost certainly running a scam. Real, sustainable wealth is built slowly and deliberately over time, not through incredibly risky overnight gambles. Stick to the boring, reliable index funds. Boring investing is usually the most profitable investing strategy. When the financial news screams that the sky is falling, simply turn off your television screen. Financial media networks make money by generating panic and anxiety to keep you glued to screens. Your long-term automated investing plan does not care about today's loud, sensationalized, and stressful news headlines. Write down your personal investing rules today while you are calm and thinking completely rationally now. For example, promise yourself you will never sell an asset just because it dropped 10%. Having written rules prevents you from making incredibly stupid, emotion-driven mistakes when the market eventually dips. Let us quickly review how to research a company if you absolutely insist on picking stocks. You must understand how the business actually makes its money and who its biggest competitors are. Review their quarterly earnings reports to see if their revenue revenues and profit margins are actually growing. Check their debt levels. Companies with massive, unmanageable debt struggle heavily during harsh economic interest cycles. Ask yourself if people will still rely on their specific products 10 or 20 years out. If you cannot easily explain how the company generates profit, you should not buy their stock. Remember, limiting individual stocks to a maximum of 10% of your portfolio minimizes total risk. Keep the remaining 90% safely anchored in those broadly diversified, low-cost market index funds forever. One of the best feelings in the world is watching your portfolio pay you passive dividends. It proves that your money is functioning as a dedicated employee, working relentlessly on your behalf. As your account balances grow larger, don't let lifestyle creep destroy your newly found momentum. When you get a raise at your job, increase your monthly investment contributions before increasing spending. This simple discipline accelerates your timeline to complete financial independence by several very important, valuable years. Financial independence simply means your investment income fully covers your living expenses without needing a job. That is the ultimate goal here. We are not just chasing numbers, we are buying freedom. We are buying the freedom to spend our time exactly how we choose, without financial stress. Investing is the most accessible vehicle to reach that specific freedom, regardless of your starting background. You now possess the exact blueprint required to start building your own solid financial foundation today. There are no more valid excuses left. The tools are completely free and easily accessible online. Open the brokerage account today. Link your checking account tonight. Make your very first purchase tomorrow. Even a small, simple purchase of a broad ETF officially makes you a true stock market investor. Do not let the fear of volatility or confusing jargon hold you back from your potential. It is a marathon, not a sprint. Be patient, stay highly consistent, and trust the process. Rebalance your portfolio once a year just to ensure your allocations remain aligned with your goals. If you found this breakdown valuable, hitting the like button helps push it to more beginners. Share this video with a friend or family member who desperately needs to start investing today. Drop a comment below telling me exactly which index fund you are planning to buy first. I read every single comment and love seeing you all take charge of your financial futures. Make sure you subscribe and turn on notifications so you never miss our weekly finance strategies. Your future self will massively thank you for taking this crucial first step right now, today. Thanks so much for watching the video. Stay disciplined out there, and I will see you next time.